Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Citi Group Inc., one of the largest financial services companies in the world, known for its global banking operations, investment services, and credit card offerings. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Citi Group has been a major player in the financial industry for decades, but from a behavioral finance perspective, how do biases like overconfidence and herd behavior influence their decision-making, especially in areas like risk management and market positioning?
Overconfidence is particularly relevant to Citi Group's approach, especially in its risk management and investment strategies. As a global financial powerhouse, Citi Group's past successes can lead to a strong belief in its ability to navigate complex financial markets and manage risks effectively. This overconfidence can drive aggressive market positioning and investment strategies, with the assumption that the firm's expertise will mitigate any potential downturns. However, this confidence also exposes Citi Group to significant risks, particularly in volatile market conditions, where overestimating the effectiveness of risk management strategies can lead to substantial losses. Herd behavior is another critical factor, especially in how Citi Group engages with global financial markets. In the highly interconnected world of finance, there's often a tendency for firms to follow the actions of other market leaders, either to capitalize on perceived trends or to avoid the reputational risks of being contrarian. Citi Group, despite its size and influence, is not immune to these pressures. This can lead to the firm participating in market trends or investment strategies that are popular among peers, even when they may not align perfectly with Citi Group's long-term strategic goals. This herd behavior can create risks, particularly if market conditions change suddenly or if the firm becomes overexposed to certain sectors or asset classes.
And this combination of overconfidence in risk management and herd behavior in market positioning has shaped Citi Group's approach to financial services, appealing to both institutional and retail investors who value expertise and global reach.
Exactly. Citi Group's strategic use of overconfidence in driving market strategies and herd behavior in aligning with broader financial trends appeals to investors looking for a company that leverages its global presence and expertise to achieve strong financial performance. However, this approach also means that Citi Group must carefully manage the risks associated with market volatility and ensure that its strategies remain adaptable in the face of changing economic conditions.
Let's talk about diversity, equity, and inclusion at Citi Group. As a global financial institution, DEI is particularly important for Citi Group. How does this intersect with behavioral finance?
Citi Group's approach to DEI is crucial, especially as the company operates in a global and highly regulated industry where diverse perspectives can drive better decision-making and client engagement. From a behavioral finance perspective, strong DEI initiatives can enhance Citi Group's ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows Citi Group to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in global banking. For investors, Citi Group's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Citi Group build stronger relationships with clients, regulators, and communities, which is vital for long-term success in the financial industry.
Investors are increasingly considering DEI when evaluating companies, especially in finance, where the ability to serve diverse clients and foster innovation is critical to long-term success.
That's right. By embedding DEI into their corporate culture and client engagement strategies, Citigroup not only improves its ability to serve a broad range of clients but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to global markets, Citigroup operates in numerous countries, providing banking, investment, and financial services to clients worldwide. How does the company adapt to different markets, and what role does behavioral finance play in this?
Citigroup's global strategy involves tailoring its financial services and products to meet the specific needs and regulatory requirements of different regions while maintaining its core focus on global banking and investment services. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with operating in diverse markets. Citigroup's ability to navigate complex international regulations, such as those related to banking standards, investment laws, and consumer protection, allows it to maintain a strong global presence. The company's approach to understanding local market dynamics and adapting its strategies accordingly helps mitigate risks associated with regulatory changes, economic fluctuations, and geopolitical tensions. By ensuring that its financial services are relevant and compliant in different regions, Citigroup can continue to expand its market share and strengthen its global brand.
And this adaptability is essential for Citigroup, especially as they face competition from both local banks and other global financial institutions. Their ability to maintain their brand's relevance and leadership in different markets is key to their continued success.
Exactly. Citigroup's focus on understanding local market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the global financial industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in global financial regulations, economic environments, and competitive pressures.
Now, let's compare Citigroup to other companies in the banking and financial services sectors like JP Morgan Chase, Bank of America, and Wells Fargo. How do the behavioral finance dynamics differ?
Citigroup's dynamics are often compared to other banking giants like JP Morgan Chase, Bank of America, and Wells Fargo, particularly in their approach to global banking, risk management, and competition. Citigroup's strength lies in its extensive global network and focus on international banking and investment services, appealing to investors looking for a company that prioritizes global reach and diversified financial services. JP Morgan Chase, with its emphasis on investment banking and wealth management, appeals to investors interested in a company that balances global presence with a strong focus on high-margin financial services. Bank of America, known for its extensive retail banking network and customer-focused services, attracts those looking for a company that emphasizes broad-based banking services in the U.S. Wells Fargo, with its focus on community banking and mortgage services, appeals to investors interested in a company that is deeply embedded in local banking markets. Citigroup's behavioral finance dynamics are shaped by its reputation for global banking, strong client relationships, and adaptability, making it an attractive option for those seeking stability and growth in the financial services industry.
And unlike Wells Fargo, which focuses more on community banking and mortgages, Citigroup's strength lies in its global banking and investment services, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Citigroup, the focus on global banking, investment services, and adaptability provides a unique value proposition in the financial services industry.
To sum up, Citigroup's approach to business is deeply influenced by behavioral finance principles, whether it's through their risk management strategies, global market adaptations, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Citigroup's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.